Hi, I'm Dave Trahair, the author of the book Enough Bull, How to Retire Well Without the Stock Market, Mutual Funds, or even an investment advisor. And I often get the question, what percentage of my money, my retirement savings, should be in the stock market? The answer to that question is that, first of all, it depends on your age. If you're starting out at a younger age, maybe you're in your 20s or 30s, you can afford the risk of holding more in the stock market because you have a much longer time horizon before you're going to need the money when you retire. Alternatively, if you're a retired person in late 60s or possibly the 70s, you have less time to make up for losses in the stock market. And this is the key with the stock market. There are potentially good returns, but those potentially good returns come at risk. And the risk is that you're going to have a period of declining asset values, which sadly we've seen over the last year and a half. The S&P TSX Composite Index, the one we see quoted in the media in Canada all the time, peaked on June 18th, 2008 at 15,073 points. It cratered on March 6, 2009 at 7,591 points. And that is just about a 50% loss, paper loss. Now that stock market, that index has increased since then. It has recovered to some degree, but it's still less than 12,000 points. So it's down something like 25% from the peak. The big question is, how long is it going to take to get back to where it was in June of 2008? That's the $64,000 question that nobody really has the answer to. But the general thinking is that it's going to be at least a few years. So if you could imagine if you were a senior that had the majority of your money in the stock market and it's now down 20, 25, possibly 30%, and you need that money, what should you do? Sell, cut your losses, or wait and hope it bounces back? That's the problem with investing in the stock market. Historically, it has returned, this particular index, including reinvested dividends, has returned on average about 9% a year over the last 50 years, which looks pretty good. The problem is that we humans tend to make investing decisions based on our emotions rather than logic. We don't behave like stock indexes. And the problem with that is that people panic when things decline, and sadly a lot of people in that situation sold when they saw the market crashing, eliminating the possibility that they could have recovered some of their money, which was the worst thing that they could have done. So the answer is to basically reduce your exposure to the stock market as you age, and it depends on how willing you are to accept the risk of a loss. If the idea of losing money keeps you up at night, then I would reduce the exposure to the stock market to a minimal amount, 10% or less. Then you're never going to really have a negative rate of return. If you're younger, more aggressive, then you could perhaps have a higher percentage in the stock market. Personally, as an example, and I'm not saying everybody should follow me, I'm 51 years old and my RSP is 98% fixed income. My only exposure to the stock market is 2%, and that's been the case for the last few years before the crash. So as a result, the stock market crash really didn't affect me at all, which is something that makes sense to me, and I'm going to continue with that strategy. So you've got to make your own decision.